All right, guys, welcome so much to this morning's class on conventional mortgages. I'm so glad that all of you could come here today and spend a little bit of time with us to go through all the details of how a mortgage works for you. This is going to be an exciting time. I know it's kind of boring, but in essence, we're going to go through the details of what a conventional loan is, what separates it from other loans, and what are some of the things that we look at when it comes to qualifying. Now, this is not intended to make you a loan officer, but it certainly is intended to give you enough knowledge so that you can go forward and make some really good, solid decisions and help your clients through the mortgage process. My name is Chris. I do have you on mute if you would like to ask a question later or during the process. Don't hesitate to either send me something through the chat box or send it to me through the unmute yourself and ask a question. Okay. And then after you're done, I just ask that you mute yourself again, because otherwise we get a lot of background stuff going on. Anyway, Chris Parks here. My information's right there. Going on to the next slide real quick. This is today's objective. This is what we're going to be trying to accomplish today. We're going to do an introduction to conventional loans. We're going to talk in general information, general terms. There's going to be different types of loan types. You would think conventional is just one. There are actually two main categories of loans in the entire loan universe. There are conventional loans, and then there are government loans. We have other classes down the road that we're going to be providing for those government loans. We're going to break those down by VA, FHA, VHDA, and other stuff like that. So we want you to attend all of these if you can. But today we're going to be specifically talking about conventional loans. There are quite a few different types underneath the conventional loans. So we're going to break it down slightly so you can have a good picture of how that works. We're going to talk about mortgage insurance and what does mortgage insurance really do. We're going to talk about automated underwriting systems, qualifying ratios. You know, what is considered an asset? How do we help them with assets to buy a house? Do credit scores influence this type of loan? What are the waiting periods for significant credit events like bankruptcy, foreclosure, short sale, stuff like that. We're going to talk all about that. We're going to talk about appraisals. We're going to talk about non-conforming loans. And then we're also going to wrap up with questions. We're hoping to get this done in about 45 minutes to an hour. And then if you have questions after the fact, we'll certainly unmute and you guys can ask as you go. So conventional financing is defined really by, we talked about this just a couple seconds ago, there are two main loan categories. Government loans, which are FHA, VA, USDA, Rural Development, USDA, and also VHDA, those are government financing. Anything that is outside of that government financing would be considered a conventional loan. Within our industry, we also call these conforming loans, because they conform to the guidelines of Freddie Mac and Fannie Mae. Freddie Mac and Fannie Mae are the ones that set all the guidelines for these types of loans, and they allow every company who wants to set up as a brokerage. Now, it takes quite a bit to get set up as a brokerage to be able to use the conventional loans. It's a great way to go. They have what they call, you can see in there, a second paragraph says government conservation, conservatorship, and that's because it is something that is handled by and identified and handled by the government themselves. So they do handle that, the guidelines associated with them, even though they don't insure them. So this is the largest space in the economy when it comes to mortgages. This is the biggest overall space of lending right now. We would say that well over half of all the loans end up going conventional loans in these days. Okay, so it's pretty important to know the sector and understand what exactly is going on with this process, with this type of loan. So what is a conforming loan? So let's talk about that real quick. Conforming loans, this is actually a little bit of old. I haven't updated this with the new guidelines as far as loan limits. But in essence, a conforming loan can be sold directly to Freddie Mac and Fannie Mae. We call them investors. And so the reason why we call them investors is because these entities, Freddie Mac, Fannie Mae, it may be a bank too that might be buying this loan. It may be somebody else along those lines as well. They, in essence, are buying or investing in the future of the buyers by funding this loan so that they can buy a house And in doing so, what they're doing is investing in their future so that they can improve their situation. Now, the loan amounts that you have on the screen have actually changed. That 484 has actually gone up to 548,000. And everything else has moved up there. So I need to go ahead and update this. You can tell I haven't taught it since before the pandemic. So, so this is those are older loan amounts, but these loan amounts I actually get adjusted every year through the Federal Housing Financing Agency, and they set it up and they send out a memo to everybody once a year to let us know what those new amounts are. And as you're seeing in the market right now, homes are really seeing a lot of inflation. A home for example, I had a client that's ratifying a contract this morning at 237. That same home a year ago was actually sold for 187. And so you can see what's happening to the market as it's going along. And that's the same thing that happens with the conforming loan limits, is they go in and they set those on an annual basis. Now, the reason why they're called conforming loan limits is because it doesn't mean that you can't buy above that. But if you are attempting to buy above that, you need to know that you're now into what is called non-conforming status. Non-conforming status, more lovingly, is called jumbo loans nowadays. And so jumbo loans, they're in a whole different category. I've done quite a few jumbo loans lately, but I'm going to tell you it's not my bread and butter. My bread and butter is actually loans under 548,000, which is that's a pretty reasonable home. Now, as we get more and more expensive in this market, kind of like in DC and Nova, in areas north of us and other places, that we may start seeing more and more jumbos coming down here because homes are really appreciated. And I hope that home at 137,000 never makes it to jumbo category, but I guess if you're in LA, that's a possibility. So anyway, so that's kind of what to think about there. Now, the last phrase that you see down here at the bottom is it says that the Dodd-Frank introduced a concept of a qualified mortgage into the equation. The reason why they did this was back in 2009 during the crash, there was all sorts of crazy regulations going on. And so what they tried to do was define this into a qualified mortgage. In other words, they wanted people to understand what was a less risky mortgage, and they started calling them qualified mortgages. Anything outside of that threshold, and we're going to talk about ratios here in a little bit, but anything outside that ratio is a non-QM. And so I know this is total nerd information, but here's what this means. Is if you're dealing with homes that have a higher debt to income proportion. So for example, Fannie Mae and Freddie Mac, like a certain debt income proportion, they will go higher than that. But if they go higher than that, they're considered non-qualified mortgages, which what that means to you is that it's a different risk level and it gets looked at very differently by the underwriters. And so these are some concepts to keep in mind as we go through this. Loan types and transaction types. So there's a variety of loan types that are within the conventional. So conventional, even though it's one main category all by itself, it still has some additional qualifying items that go with it. For example, there are fixed rate, adjustable rate. They do have hybrid loans. They do have balloon loans. There are other factors that would fit into what is considered to be a conventional loan. So that you can see that there's a lot available to there. They do have, they had some before the financial crisis, before the crash of 2009. There were a lot more flexibility in this type of loan than there is nowadays when it comes to a conventional loan. So when I bought my first house in 1996, all they asked me for was one pay stub and my social security number. That was it. That's all they asked me for. And I bought the house, and literally I didn't have to prove anything. All I had to go was show up and sign, and that was it. Nowadays, things have changed significantly. With those, they've also changed the way that they look at some of these loans. So there used to be what it would be called a negative amp or a negative amortization. So in other words, you had 3 payments that you could pick. If you picked the lowest one, whatever was left over from that payment from the true amortized payment, which was over here, that got added to your loan. And so your loan amount could go up you know, that kind of craziness has gone away. They're not letting people do that anymore. That was a big reason why we had the crash in 2009. And so that was part of what happened there. And so they try to get rid of it. They also have, you can see the second bullet point there, it says home style. And home style and those are renovation loans. Freddie Mac and Fannie Mae do have conventional versions of the renovation loan, and those renovation loans are actually tremendous. So if you have somebody who has a good credit score that's buying a house that needs a little love, or maybe they talk Dustin or one of the other people here at buying one of the homes that they're getting ready to flip, and then they can do whatever they want to it. That totally works. They can do this. Now, what you need to know with the renovation loans, and this is just a real quick snippet for the benefit of you, is what you need to know is that these loans take about 60 days to get done. So if you're going to get into the renovation stuff, which now is starting to be a little bit more popular only because there's not much inventory out there, this is actually not a bad loan to get into, okay? You can see in the third bullet point there, it says second mortgages, which include Helocs. So a Heloc is a home equity line of credit. They use a lot of the conventional guidelines, and Freddie and Fannie don't purchase them, but they use a lot of the guidelines that are like that. And so, you know, they don't have as wide, but these, and I went too far, sorry. So they went into owner occupant is the primary source for these homes, but you do need to realize that they can do a lot of investment. Now, this is not flip money. In other words, if you're going to go in and you want to try to flip a house, this is not that kind of money. This money is designed for buy and hold. So if you're going to be buying a home with this, you need to be able to guarantee that you're going to be keeping it for a minimum of 1 year. Now that 1 year goes by pretty quickly. So it's not necessarily something that you have to hold on to forever. And I'm not a CPA, so I don't know how the capital gains all works out, but I know that if you hold it for a certain period of time, the capital gains works a little bit better for you. But anything in the traditional purchase market, whether it's conventional or government, you're going to be certifying that you're going to live there a minimum of 1 year. Okay. All right, moving on to the next one. You can see, okay, Terrence, you had a question, go ahead.
Yeah, I wanted to just ask you if one's trying to purchase a house, would they just get the renovation loan that would encapsulate the prices of the home plus the repairs, or is the renovation loan like an additional loan that they would have to procure after getting a conventional loan to get the house?
That is a great question. We actually have an entire class just on renovation loans that we can do in the very near future if you guys would like to do that. But how, I'm just going to give you a real quick nutshell on it so you can kind of, percolate until we have that class. So if you bought, let's just say the home is listed at $200,000, but it needs $50,000 worth of work. Okay. You're actually buying the house from the seller at $200,000, but your loan is going to be for the full $250,000. Now that $50,000 gap of cash gets pulled out and put into an escrow account, and it sits in the escrow account. And as the builder is doing work on the home, he gets to take little pieces based off of the milestones that he's agreed to. And so in other words, if one of the milestones is get the kitchen done, then once the kitchen's done, he can take out that milestone. If one of the agreements is he's going to do the heating and cooling system and the roof, then he gets to take the money out and get paid for that. It's not like every week I get to show up and ask for a check. It's based off of milestones. So it does work, and we'll address it more when we deal with this strictly the renovation loan.
Okay, thanks.
Great question. So one of the questions we had here in the room is, can that be done by a homeowner? And the answer is no, you cannot do it as a homeowner. You actually cannot do any of the work yourself. It has to be done through a certified contractor. If you want to do the work yourself, then you need to buy the home in a good enough inhabitable condition so that you can move into it and then later use your own cash to do the renovation. Okay. All right, moving on. Eligibility. So eligibility for this type of loan is actually pretty wide and encompassing. And conventional loans are the types of loans that you really want to get into long term. Government loans are great to help you establish the house, but conventional loans are the ones you want to get into long-term because they provide you with better benefits long-term. So they are open to a variety of people. So you can, as a citizen, obviously you're fully entitled to one of these. As a non-citizen, there are certain categories of non-citizens that we can, I've worked with every category of non-citizens in this type of loan, but they're a little bit more restrictive to some of these. And if you're dealing with somebody who has no level of documentation in this country, meaning they don't have a visa status in this country, they don't have a work permit, they're not non-permanent resident. We call them, in essence, aliens. I don't know why they have to call them that, but they call them aliens. They don't have little fizzy things that stick out of their heads, but they're aliens in essence. And so with those types of people, there's a completely different set of guidelines, and they would not be eligible for conventional loans. Now, business entities, LLCs, I get this question a lot. Can you buy as an LLC? And the answer is no, you can't buy as an LLC. You have to buy as a guarantor, and you can then move it into an LLC, but the loan will always stay in the name of the guarantor, okay? If you want to put it in the name of an LLC, now you're dealing with a commercial loan, which is very different than a conventional residential loan, okay? So business entities, you can't do it like that. And builders can't do their inventory. And this is why builders have, they have their own builder lines, and they have to do this. Now, Fannie Mae and Freddie Mac are very loose with their terms, but once you get to be a mega investor, and I have some people that I work with that have 200 homes in their own personal inventory as real estate. Well, at that point in time, why would they really need me? Okay. And so the answer is most of the time they don't. They're self-funded, they have their own cash, and Fannie Mae and Freddie Mac, they only want to take so much risk when it comes to this. Okay. So when you're dealing with multiple finance properties, they're willing to let you do a total of 10 with Freddie Mac Freddie Mac allows 6, Fannie Mae allows 10. And so that's the maximum you're going to be able to get under this. Now, I'm going to tell you, if you have 16 homes, you're not doing bad, but just keep in mind that that's what they have. Once you get past that threshold, now you either have to go into hard money or you have to go into commercial. A lot of places go into pool loans, which means that they take, like this guy, he had 200 homes that were in this pool. And what he did with that pool is he would sell one and replace it with another one. He would sell one, then he would replace it with another one. And so those are kind of aspects that you can do once you get into that standpoint. But Fannie Mae and Freddie Mac, they're not going to lend forever on this stuff. They got a threshold of max, which it makes sense. It makes sense. Now, down payments and mortgage insurance. So the down payment threshold, you can get in with a conventional loan. If you are a first-time home buyer, you can get in with a conventional loan with a minimum of 3% down. Now that is really, really strong. And I'm going to tell you that if your buyer has 3% to be able to put on the table for something like this, it is a tremendous way for them to buy this house. It has much better terms because they're putting some skin in the game. We're going to talk about VHDA, USDA, and some of these other programs later, but anything that you put a little bit of skin in the game is going to be significantly better priced in rates and in terms than if you're getting 100% financing through Virginia Housing or through some of these other places out there that have grants or down payment assistance or items of that nature. So 3%, but now that's limited, strictly limited. That 3% is to first-time home buyers. So you can't get, for example, my son wants to buy a house. He's a first-time home buyer, but he wants me to co-sign. Okay, so with me co-signing, while that works, he is no longer considered a first-time home buyer. He is now considered just a regular buyer out in the market. And so now he no longer qualifies for that 3% down. Instead, first-time and second-time buyers now have to go in with 5% down. And so that's what you're looking at. 5% is the basic entry when it comes to buying a home with that. And this is where I give you a real quick tip, a seller's tip, because you're going to be talking to people who want to upsize. And this is tremendous. This is a great play. So if they have home A, that they really don't necessarily want to sell, but they don't have 20% to go into home B, okay, they can get in with 5%. And with that 5%, they can use the rental income that's coming in off of this home over here to offset the payment for this home. And as long as they have 5% for the new home, they can do both simultaneously. And so it's a tremendous way for people to be able to get in the door if they're looking to make that move up. And I actually have people who do this every 1 to 2 years. People who save up enough for a minimum of 5% down payment. They bought their first house low, and then they start working their way up. I have people that have bought 6 homes with me, and literally every year, because they're committing to 1 year in the home, every year they're moving up, and they just have to build up that 5% to make it happen. But then here's the thing with down payments, the rates, the mortgage insurance, everything else is by those factors right there. 3%, 5%, 10%, 15%. And at 20%, you no longer have mortgage insurance. Now you can see the next line item there is mortgage insurance. And so mortgage insurance, what you need to know, is a tremendous tool to help you buy a house if you don't have 20% down. Now, it's kind of one of those tools that is not very sexy, because in essence, what you're doing is you're buying an insurance policy against yourself in case you have to turn the keys in. So obviously you don't want to keep that for very long. You want to turn that back in, you want to pay it off. So the sooner you get to 20%, the sooner that thing goes away. Now, there's several different versions of mortgage insurance, and each one has its own purpose and place in the market. So personally, I prefer the monthly one. And the reason I prefer the monthly one is because when I buy a house, this is my strategy. I am not going to be making just regular payments on this house. I want to pay that bad boy off early. And if I can pay that bad boy off early or get to 20% early, I can save myself a boatload of money. Okay. So here's what I mean by that. If you have a home at $200,000 and you're paying $115 a month in mortgage insurance, okay, take your calculators out, pull out your phones. Let's do the math together. $115 a month times 96 payments. How much money is that?
$11,040.
Okay, so that's how much you would pay if you didn't make any additional payments on this house. But let's say that 115 a month, you got it done in 48 months, which is 4 years. You got to 20%. So 115 times 48 now.
5,520.
How much money have you just saved?
5,520.
Right. That's the reason why I like that version, because the sooner you get to 20%, the sooner that bad bag goes away. Now, there are other ways of doing this. There's upfront premiums, there's split premiums, there's lender paid. There's a lot of places out there that advertise no mortgage insurance. I'm going to tell you, they're full of crap. It's just full of it. Because what they're doing is they're doing one of these other versions. It's costing you money to do it. They're selling it like they don't have any mortgage insurance, but there is mortgage insurance. There's 2 ways at this, there's 3 ways actually. The monthly way, which is my preference. There is the single premium paid, okay, which means that you pay 1 fee up front and then you never have to pay mortgage insurance again. There's a split premium version, which is the same thing, okay, as that. And then there's the lender paid version, which is the lender in essence paying for it. Now, in any of these scenarios, you're still paying for it, but you're paying for it in a different way. Sometimes it's by a higher interest rate. Well, guess what? That interest rate, if you stay in that house for 30 years, you're going to pay 4 times what you would have paid in a monthly version over 30 years if you're making that happen. So you have to kind of think through which one makes the most sense. I don't expect you to remember this, but when you get out into the market, you start talking to people about this stuff, just keep in mind that there's no such thing as no mortgage insurance. There's just a different way of hiding it. Okay. All right. Now, there is some really good options for low to moderate income people when it comes to conventional loans. I use this program an absolute ton. It is a phenomenal program. It is designed specifically for first-time home buyers. It's called Home Ready or Home Possible through Freddie Mac and Fannie Mae. It is a 3% down, and it has subsidized mortgage insurance and subsidized rates. But it has a maximum income qualification, which what that means to you is if you're making over top of their threshold, you may be able to get 3%, but you're not going to be getting a Home Ready or Home Possible. They're extremely sensitive to income. And I think what their income is based off of the median income of the surrounding area. So the metropolitan statistical area of Richmond, I believe the median income is like $80,000. And you have to be below that in order to qualify for this program. Now, if you do, this is a tremendous program. But keep in mind that if now you're going from Richmond down to Dinwiddie, you may be in a completely different metropolitan statistical area, and that may bring it back down. But this one right here, the rates are less, so that's like almost 1/8% difference when it comes to the rate with this type of program versus a regular 3% program. And it's also, the mortgage insurance is subsidized, so many times it's lower than what you would encounter with the other one. All right, moving into the automated underwriting system. Now this one right here, I can't accentuate enough. I'm going to tell you some tips and tricks with this here real quick on how to vet your buyers if they're not coming from a lender that you fully understand or know how they work, okay? This is extremely important. So automated underwriting systems, or the AUS, that's how we lovingly refer to it in my world, is in essence, the only way that a loan gets done. There's two ways a loan can get denied. Reason number one is you don't have AUS approval. You have to have AUS approval if you're going to get a loan. AUS means that Fannie Mae and Freddie Mac have an automated underwriting system that checks all the data points of all the pieces, all the boxes that we put into the file, and we run it through their automated system. It takes about 30 to 45 seconds for us to run it through that system. Once it gets spit out of that system, it renders back a decision to us on either a thumbs up or a thumbs down. Now, here's the reason why this is important. It costs money to run it. Not every loan officer is willing to run this before they issue the pre-approval. But this tells us whether we have a loan or we don't have a loan, because it's not just checking the data points of the file, it's also checking the government files to see if there's anything caught in the system, like unpaid taxes, like judgments, like things that are not reported on their credit report, because judgments are not required to be reported on the credit report, but they will find them. Okay, so this is extremely important. Now, why is this important to you? It's extremely important to you because I don't care what bank you like, what loan officer you love, if you don't have AUS approval, you're not getting a loan. Period. End of story. You're not getting a loan. So that's number one reason as to why you're going to get it failed. So here's the question that you need to be asking the loan officer who has pre-approved your buyer, or you've received a contract on a listing that you have, and you're trying to vet the buyer, you're trying to vet the agent, the loan officer, to make sure that they did their work. Because, you know, this is right here, this is extremely important. So what you need to ask is, number one, have you run the AUS for this client? This applies to whether it's a buyer or you received a contract as a seller. You call the loan officer, have you run AUS? If the answer is then you may need to encourage your buyer to find another lender, okay? Because if they haven't run it, that means this person has not done their due diligence on this buyer. Now let's talk about pre-approvals real quick. Pre-approvals, the baseline for pre-approvals, the requirement by the federal government is this: stated income, stated credit. That means I don't have to pull a credit report. I don't have to look at pay stubs. I don't have to verify they have a job. I don't have to do any of that stuff. So I can issue a pre-qualification just based on you calling me and saying, I make $60,000 a year, my credit score is above a 650, and my job, I've been there for 2 years. Now, that doesn't take into consideration self-employment, commission, any of this stuff when it comes to incomes. It doesn't take into account any of that stuff. So this piece right here, if they've gotten it and run it through automated underwriting, and I'm sure none of you have ever had a file that fell apart, right? None of you? Yeah, this is the main reason it falls apart, is they did not get the data point straight when they ran it through AUS. So question number one, have you run AUS? Now, once you've run AUS, it takes 30 to 45 seconds for it to pop out an answer. Once it pops out an answer, it gives us a list of items that we have to check based off of the data points that we put into the application. Guess what? Freddie Mac and Fannie Mae will not approve a loan unless those data points are satisfied. So when it spits out the conditions, we have to go out and we have to go verify that these conditions are, that's what the underwriter's doing. Do they have enough income? Does your income match what's on their pay stubs? Are they self-employed? Are they? Those are the questions we have to ask. So question number one is, do you have AUS approval? Question number two, are there any conditions on the AUS approval that your buyer will have a hard time satisfying? Because it's already spit out all the conditions. Okay. Now, the reason why that's important is, once again, if you ask that question, it's going to tell you whether this person's actually looked at the findings and actually knows whether he has a good buyer or not.
Could you repeat the question?
Okay. Repeating the question. Does your buyer, have you looked at the AUS findings, and does your buyer satisfy the conditions from the AUS findings? Okay, extremely important question. So those two questions, number one, have you run AUS? Number two, is your buyer capable of satisfying the conditions from the findings? Those two questions will now put you into the green beret status of real estate. Okay, now we're going to move into Navy SEALs. Okay, Navy SEALs. Question number three. Does your bank have any overlays that might prevent the buyer from buying this home? Now, let me explain what overlays are. The first two questions are specifically related to the AUS. The third question is related specifically to the bank, because Freddie Mac and Fannie Mae are the baseline for getting a house. But many times the banks say that's not enough. We want additional items on top of that. And so while the baseline may be here, we're going to add a whole nother list of guidelines to go on top of it. Now, the problem with that is they may make it more difficult unnecessarily. And so in our system, those are called overlays. I'm adding stuff on top of other stuff in order to see if I have a better client. They may still conform to those overlays, and it's fine. But that question right there is going to let you know what you have and what you don't have. And so whether you're dealing with a buyer or you're dealing with a seller, these are going to be the most important factors that you need to ask when you're evaluating where this person is. Because the last thing you want to do is drive people to 25 different homes and then have the loan denied because of either a lack of due diligence on the loan officer's part by not submitting to AUS, or they didn't check their overlays. Okay. Anybody ever had that problem before? Yeah, Terrence.
Definitely. Can you say the last question again? Does your bank have any overlays?
Yes. Does your bank have any overlays that the borrower will have a hard time satisfying?
Thanks.
Okay. All right. So we've gone enough on that one. If you have more questions, by all means, catch up with me later. Qualifying ratios. So the qualifying ratios, this is how we actually determine whether a person has the ability to buy this house. we're going to be looking very carefully at these people's qualifying ratios, because after we get credit, there's three main factors that affect every loan: credit, income, and assets. Credit opens the door, income tells us how much house they can afford, and assets helps us guide them to which program and what down payment we need to go with. But now what we're dealing with income, okay, income determines based off of their qualifying ratios, in other words, debt to income proportions, how much they can do. So what we're going to be doing when we look at these items is we're going to be looking at student loans. We're going to be looking at child support. We're going to be looking at credit card payments, car payments, collections. Yes, we look at collections. We look at judgments. We look at all these items, and we have to put ratios. Even if they're not making payments on a collection, we have to include, at some point, they're going to be required to pay these back. We have to include some money in there for that. Student loans, same thing. They may be in forbearance right now, but at some point they're going to have to be paid back. So we have to include a monthly payment for it. So we have to go in and we have to, if there's nothing there, we have to calculate to make this work. Not only do we look at those debts, but we look at the purchase price of the home, the down payment of the home. How much is going to be the principal and interest? How much are going to be the taxes? How much is going to be the homeowner's insurance, the mortgage insurance, other aspects like that? And we add that whole ball together, and it has to be underneath a specific debt ratio. Now, there's a soft stop and there's a hard stop. The soft stop is 45% debt. The hard stop is 50% debt. And so many times when I'm looking at people and they think they are so awesomely set up, like I saw somebody just yesterday who had $250,000 worth of student loans.
Ooh, were they a doctor?
They were not. They were not a doctor. They were in HR. And unfortunately, these people are never going to be paying that back. They're just never going to be paying it back. Now, the worst case of student loans I ever saw was $960,000 worth of student loans. Now, before you get too scared, this person was going to be a surgeon, no soup lines in their future, just so you know that. They probably would pay them back, but their monthly payment just on student loans was $10,000 a month. Crazy money. Okay. Now, having said that, we still had to include that into their debt proportions. So if they go over that 45%, now we have to look really, 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 really carefully. I don't know if you can see my eyes or not on the camera, but really carefully, we have to look really carefully at these things to make sure that where we're headed with this is in a good place and that we're not setting people up for failure. We have to have compensating factors, ability to save, good credit scores, other items like that. If there are non-occupant co-borrowers going to be in there, then we can look at that too. That means grandpa, like in my case, I'm going to be helping my son buy a house. I'm going to co-sign for him. They're going to look at my income on top of his. How much money are we putting down? If the borrower is putting some money in of their own, different things like that. All that's going to be included in these qualifying ratios. But the two main ones you have to remember is there's a soft stop at 45 and a hard stop at 50. Going into the next one, cash requirement. Owner occupants, you have to put a minimum if you're a first-time home buyer, 3%. Now this page is actually pretty important right here because it tells you how much you can get as far as seller concessions as well. In other words, we call them interested party contributions. So if you're putting 5% down, okay, you have a 3% maximum seller contribution that you can get. That means only 3% of the purchase price of the home can be used towards closing costs, prepaids, other items of that nature. Okay. Now with the, once you're getting into a second home, you now have to up that threshold to 10%. But that threshold of 10% also means that you can ask for more in seller concessions. And you can see that there too. Once you get past 75%, you can ask for even more. If you're doing an investment, you can only get 2%. Now, here's the thing though. If you get 9% from the seller, you're probably going to lose it because it's use it or lose it. And you can't use it towards a down payment. It's only towards real and actual costs. So I've had this happen in the past where they can get a total of $7,500 and we got a seller concession of $9,000. Well, they just lost $1,500. Can't even use it. And so you have to be careful as you're making these offers. You have to call the loan officer, find how much you can get, find out how much of this they've already received. And interested party contributions are anything from the seller, anything from either realtor on either side, and anything from the lender. Those are considered to be interested party contributions. Okay. Gifts, you can get gifts for anything you want. Now, keep in mind that if you're going for a multi-unit and you're getting a gift, the down payment requirement does go up. So keep that in mind if you do that. Cash reserves many times are required for people buying homes, and reserves, what that means is additional savings. The reason why they want additional savings is they want to make sure that after this transaction is over, that you have the ability to eat, that you have the ability to keep the lights on, that you have the ability to pay bills. And if you lose your job, you have the ability to make a few extra payments before you find the next job. So these are all parts of what they require when it comes to cash reserves. Going into cash reserves, as far as requirements, you can pull from a variety of places. For example, you can pull from liquid and non-liquid sources. And so, for example, if you have a 401k, that can be considered a source of reserves. Stocks can be considered a source of reserves, but we have to look at it very carefully because, for example, if you're a teacher in the state of Virginia or Richmond, they're a part of the VRS system, the Virginia retirement system. The problem with Virginia retirement system is you are not allowed to take any type of distributions out of this system and apply it towards anything. And so we have to look carefully at these 401ks to make sure that there is an ability to pull this stuff out. Okay. So borrower funds, that's pretty important. Purchase money seconds. We do run into this periodically where people are trying to buy a home and they're trying to avoid mortgage insurance. And so they get what we call an 80-10-10 or an 80-15-5. In essence, they're putting, in the last scenario, they're putting 5% down. They're getting a home equity line of credit for 15, and they're getting a true loan for the full 80%. There's pros and cons to that. I've done it quite a bit for people. It sounds like you might be getting away with one by avoiding mortgage insurance, but what you need to know is that you're really not, because that home equity line of credit is actually at a higher interest rate and it's interest only. And that interest moves every month. And so 1 minute it might be at 2%, next minute it might be at 6%. And so in essence, while you're trying to skirt the system and get around it, I totally get it. That's cool. I have used these in very specific occasions. I actually just did one probably 3 weeks ago where the guy was buying a $960,000 house and he was trying to get it down below jumbo. And so we got it down below jumbo by doing a second home equity line of credit. It worked fine, but in the essence, in my opinion, it wasn't the best suited for him, but that's really what he wanted. So after I gave him the pros and cons and he decided to go that way, we just kind of rolled with it. So, all right, credit scores. So credit scores, when you're dealing with conventional homes, you can go down to a 620. Fannie Mae will accept a 620, but I need to let you know that Fannie Mae is, while they're taking the risk long-term with it, with the bank or with a loan, they're not the ones funding the loan. And so most banks, even though you can go down to a 620, they're really not going to be willing to give you a loan down to 620. And the reason is because if they fund it and it goes belly up, they're the ones out the money, and it has to perform for a period of time, or it's called a non-performing loan. And so the bank has to pay it back if it's a non-performing loan. And that's just really ugly. So most banks, even though theoretically speaking, 620 does work, they won't do it until you get up into a 700 credit score. Now, I have done conventional loans down to 620, but let me tell you what, they were putting 40% down. They were putting between 40 and up. So it does work, but not many of your buyers are going to have 40%. Okay, so kind of keep that in mind when it comes to some of that stuff. The mortgage insurance guidelines, that stays there. We talked about that. And mortgage insurance, that's the next thing. Mortgage insurance is actually driven by your credit score. And so if your credit score is pretty low, you're going to have a really high mortgage insurance payment. Okay. All right, significant credit events. This is important too. Short sale is actually seen as a foreclosure. So if you're doing a short sale on a home or they've done a short sale on the home, you're going to be required to have at least that 4-year waiting period in there. This is a great matrix to go through. Bankruptcy, Chapter 7, Chapter 13, those do work. Now, I do have a fair amount of people. So in 2009, between 2009 and 2013, about 10% of America lost their home to foreclosure because of the crisis. And that was a disastrous time. Those people are coming back into this market. And so if you're dealing with somebody who has been through foreclosure, who has been through bankruptcy or something like that, here's a couple things that you need to know. They have to show signs of recovery. A 620 is not a sign of recovery. 640 is not a sign of recovery. You need to be showing strength in your credit scores. And from the time you lost the home or you had a bankruptcy or whatever else happened, you have to have 0 lates, 0 collections, 0 anything. Okay. I don't care if it's a $25 collection with the bubble gum company, whatever it is. You can't have any collections if you want to go conventional. There's a 4-year waiting period. You have to be living like a monk or a nun for that period of time if you want to go conventional. Okay. Now you can go into FHA, but I'm going to tell you that we'll talk about that later. It's not as clean as it sounds. Okay. So we'll go through and talk a little bit more about that in time. But just keep in mind that they look very closely at these things, and we have to make sure that we've completely recovered and that there is no path back to that situation. In other words, you learn from your mistakes so well that you are not going back to foreclosure, you're not going back to bankruptcy. Okay. So anyway, important stuff there. Properties and appraisals. Every property is going to be required to have some sort of evaluation on a property. Now, having said that, since COVID, we have been seeing a whole lot of property inspection waivers. I just got one the other day, yesterday, for a home property inspection waiver for somebody who's buying a house. They're actually closing in about a week. Okay. So keep in mind that the property inspection waivers are super cool. What's happening is Freddie Mac and Fannie Mae have looked at the different properties around the area, and they say we have enough data points in homes around the area because they keep track of all of these reports. And they say we have enough data based off of the sale price, based off the down payment and this person's credit. We think that this is a good risk, and we're going to waive the inspection because we have enough information around that. Super cool, especially in today's market, because a lot of homes aren't even appraising. Now, if you're required to have an appraisal, what the appraisal is going to be doing is they are going to be verifying that the value and the condition of the home are supporting the purchase price. In other words, that you're not overpaying for the home. In a traditional market, you can renegotiate with the seller if the value comes in above it, and if you bought it here and the value comes in lower. Now, if the value comes in higher, we don't have to worry and say anything. But these days, the biggest concern is you bought it for here, but the value came in here. Okay. Now, these days, with where the market is, you may not be able to renegotiate, but in a traditional market, you certainly can. Now, for conforming, there are acceptable properties that they will go look at. So I dealt with a family recently that had their own compound. In other words, they had 2 homes, they had 20 acres, and they had 2 homes on those 20 acres. So they built a home here, and then Junior decided that he loved Mom and Dad so much that he built a home right here. They were far enough apart, but it was still the same property. Because it was still the same property, that's considered non-conforming. It's just non-conforming. We can't get any comparables within the last 6 to 12 months that make enough sense to say that we have 2 homes on the same exact property that would make this work. And so they're going to have to go with a commercial loan. There's nothing else that can be done with that. Okay, it's tougher, or they can get a surveyor to come out and draw a line and kind of parcel it up and move it on. And that point we can refinance. But you have to think about it from the standpoint of what has happened within the last 6 to 12 months that has some of that same stuff going on. So if this is a very unique property, I dealt with one last year in Hanover where it was a very, very, very nice property with 15 acres. And the purchase price obviously made sense because they bought it. They bought it at $960, but there were no comparables within the immediate area that supported that home. And so this appraiser had to go out further into other areas in order to be able to find enough homes that met that criteria. Now, I'm not going to dive into appraisals much more than that. I have a separate class just on appraisals. We'll deal with that at another time. But just keep in mind that they have to find comparables in order to make this work. Some conforming lands that do not finance. In other words, conforming loans will not take raw land. You have to get a different kind of loan for that. Okay, so Freddie Mac, Fannie Mae do not govern raw land. They don't govern farms. And roads that don't have accessible, or homes that don't have accessibility roads. Condotels is another one. And anything that has rollback on taxes. So in other words, it's all sorts. There's plenty that they will accept, but there's some determining factors here that they're not going to accept, and just kind of see that least. When it comes to property flipping, this is not flipping money. It is specifically just money for buy and holds. So if a builder wants to use this as a source of financing to flip, it ends up getting to be an issue, okay? Because you are certifying when you buy these homes that you're going to maintain them for a minimum of 12 months. So if you start showing a pattern of flipping these, they're going to start coming to you and asking you why you're committing mortgage fraud when you're saying that you're going to be maintaining these for at least 12 months. Okay, so that's a very important piece. Now, properties that have been sold with less than 90 days, those are considered to be a flip. The true definition of a flip is a home that was bought, let's say January 1st, and was sold on or before April 1st, which would be 91 days. Okay, if it was sold on or before April 1st, less than that 90-day window, it is now considered to be a flip. Within that window, it doesn't mean you can't do it, but what it does mean is that the underwriter, if he doesn't see the value of the work that you've done to this home, they can ask for additional things to be happening. One of the most common ones is that you provide a copy of all the work that you've done and that you detail roughly how much each one of these pieces cost. Not because they're not trying to cut you out of profit. They want you to have a profit. They just want to make sure that you're not putting lipstick on something and truly not doing it, which was one of the biggest issues in 2009 through 15. People were just putting lipstick on homes and putting them back out on the market with crazy numbers. And in essence, they were fleecing. There was entire fraud schemes built around that. And so they're really careful about that 90-day window. The second thing that they can require is they can require that you get a second appraisal. And so that's a pretty big deal, okay? All right, so property flipping right there. The next one is non-conforming loans. We've actually talked about this. Non-conforming loans is not just for jumbos. You can see there's a little list right there, such as non-approved condominiums, foreign nationals or aliens. We talked about that earlier. Bank statement loans. We deal with some people who have great income, but they don't have anything that's provable, and those are called bank statement loans or non-traditional lending. Those can be done too. There's a variety of different loans out there that can be done as non-conforming loans, and they're tremendous. They're really good loans to help people get in the door. We used to have access to them, but I'm going to tell you that they're very expensive loans, and they're not always for everybody. So certainly something worth taking a look at if that's what you need. All right, so we have come to the end of this meeting right now. And I just wanted to share this. I'm gonna stop recording here in a second, but I just wanted to say thank you for everybody who came out today and spent a little bit of time with us going over conventional loans. And I'm going to open up the floor for conversations and also questions. If you have any questions, we have some people here in the room who might have a question too, or somebody online. Okay, so thank you so much for your time. Go ahead with the questions. Anybody?
I have a question.
Yes.
First time home buyer, is there a time frame that you become a first time home buyer again? Like,
Okay. Okay, that's a great question. So the question in here in the office is when is the timeline for a first-time home buyer to be a first-time home buyer again? So Freddie Mac and Fannie Mae have a very distinct guideline on that. If you have not been on title or on the loan of a home for 36 months,
Really, that's it?
you are considered a first-time home buyer. So if
Wow.
that means in January 1st, you are no longer a homeowner, 3 years, 36 months to the day, January 2nd, 3 years later, you would now be considered a first-time home buyer. Okay?
Wow, that blows my mind. It's on 3 years.
So like people that are coming out of foreclosures and bankruptcies and things like that would actually
They would.
be first time home buyers?
Yeah, so the question is people coming out of bankruptcy and foreclosure, because of the waiting periods, they would be considered by most circumstances, first-time home buyers. Okay. Any other thoughts, questions?
I
I have a question. Can you hear me?
Yes, go ahead.
Okay. Hey, Chris. So I was just doing some research previously just regarding the loans and whatnot, and I did come across basically it's a loan for home repairs, and I just
Mhm.
wanted to get some clarification on that. I know that you did mention there is a loan that you can purchase with, to fix up a home, but isn't there one that is for current homeowners that they can actually qualify for as well?
Yeah, it's the same exact program. It's called a renovation loan. And you can use it either for a purchase or for a refinance. And so if the people would like to take their home that they're currently in and get some cash out to do the work, they can certainly do that. There's 2 ways to do that. The renovation loan is actually not a bad way to go, but you do have to involve a contractor since you can't do any of the work yourself. The second way is to get a home equity line of credit. And with that home equity line of credit, then you can take the money out and do it yourself. So there's 2 opportunities to do that. The renovation loan definitely works very well though.
Thank you so much.
All right, thanks.
I have a question.
Yes.
So I have a potential future client and they're looking at houses that are very expensive and they're going to be in a jumbo loan situation for sure. They have really high income, but they don't have a lot of savings to put a lot down.
Okay.
They talked to another lender and they were told by this person that because of the way things were shaking out, what they needed to do was get 2 mortgages instead of a jumbo loan.
Mhm.
Can you explain that a little bit?
So that's the 80-10-10 that we were talking about earlier and the 80-15-10. You can certainly do that. And I actually just had a client that did that.
Mhm.
So they tried to, because of the situation, once you get into non-conforming status, meaning a jumbo loan in this case. So when you get into a non-conforming status with a jumbo loan, you are actually required to put 20% down.
Right, exactly, and they couldn't.
And if they don't have 20% down, then they have to find creative ways to get there, which many times what that means is getting an 80% first, getting whatever you need to out of a home equity line of credit, and then also getting the balance from your own cash. Now, usually when you're dealing with something at that height, you're still going to have to put 10% down in order to get there, but it is more common than you think to do that. And part of the reason why is because COVID messed a lot of people up. It also messed lending up. During COVID, because of the law where people could forbear their mortgage for up to a year, all of the banks pulled out of jumbos. And so we used to have 5% down jumbos, 10% down jumbos, and other jumbos like that. But all of that stuff is gone now. And so now if you want something non-traditional like that, you certainly can do it. But it has to be in a situation like that.
Right, yeah, that you're describing exactly the situation. They didn't have enough money to put down, but they make a lot of money and they have very good monthly income, but they just have a lot of savings. And I think the house was like $899
right
or something.
Yeah.
And they were like, oh, we can pay for it, no problem, but we don't have anything in savings.
Right. Yeah.
And I was like, okay.
But you still have to get whatever you have to get them to put a minimum amount down. So here's how foreclosure works in those situations. And so this is how the banks are going to look at it. The banks look at foreclosure in that scenario as first in, first out. So if you're registered first on the loan, that's who's going to get, in other words, you registered first as the primary lender. That's the person that's going to get paid first. then the second lien, and then
Right.
so on all the way down. And so the home equity line at being taken subordinate or second place on this loan, since they're going to be second in line, many times they look at it like, you're gonna have to put at least 10% down so that we know that we have at least enough equity in here to be able to regain whatever losses are when this home is sold. So anyway, a little bit on that. Okay.
Can you speak to forbearances? I've heard two different things. I've heard one that it's no big deal, just add it to the end of the loan. But I've also heard of the other where people think they're adding it to the end of the loan, but when the forbearance period ends, it's due.
So forbearance, so the question is an explanation on forbearance, and this is actually going to be a very big topic going forward, and so it's worth your time because we're going into a time when a lot of people are going to be running out of forbearance, and there are three options with forbearance. Now, they have to specifically push each bank in these areas because not every bank is going to want to do these, okay? There are three options. Option number one, which is the most difficult one, which is you pay a lump sum at the time in which you come out of forbearance. That is very difficult. And those who went into forbearance not needing forbearance are the ones who are going to be able to do that because they've saved their payments and et cetera, et cetera.
Nobody said
Nobody.
payment.
Right. So that's option one. Option one. Option two is they can take whatever they forbeared during that period of time and they can spread it out over the next 12 months. Meaning that if it's $1,000, they owe $12,000 and it was $1,000 a month, they spread that $1,000 on top of their regular payment. Okay. So in essence, that's option number two. Option number three is that they work out a renegotiation with a bank and it gets added to the end of the loan. Now, none of these are automatic. The only one that's automatic is the first one, which is the lump sum at the end of the forbearance. But I'm going to tell you that most people are not going to be able to do that. But just because they're not able to do that doesn't mean that the other two solutions might not work. Okay. And so just kind of keep in mind when you're counseling, because they're thinking they're going to go into foreclosure. It's not necessarily like that. They get those three options, but they do have to work with their bank to get it with it.
Does every bank offer those three options?
They're required to by law.
They're required to offer the third one too.
They're required to.
Good, so they may have to push
Yes.
push for the third one because they're gonna not want to give them
Right.
the third one. They're gonna want to go 1, 2, 3
Right.
in that order.
Yes.
And when is the forbearance ending?
The forbearance was up in 12 months from when they established it, which I think was in June of last year. We should be coming out of it like right now.
So are you seeing anything in the market?
Am I seeing? Not yet. I mean, they've talked about doing additional things as far as extending it. I don't know what that's going to happen. Anyway, for those of you online, I want to say thank you. I've taken more than enough of your time. I'm going to end this session right here. By all means, if I can help any further, don't hesitate to come in, stop in, see me, see Kara, see Brenda, and we're happy to help you with anything else going on as far as questions. Thanks so much.